What if the most successful gamblers in the world weren't motivated by money, but by the intellectual thrill of proving the world wrong? What if the market isn't a factory for passive wealth, but a fierce, unforgiving arena where the ultimate test is self-mastery? Most books on finance teach you how to invest, how to buy and hold, manage risk, and accept the base rate. But there is another world, the world of the speculator. The speculator aims for abnormal returns by exploiting short-term anomalies, betting against the consensus, and embracing the kind of high-stakes risk that makes traditional investors gasp. This path is paved with staggering profits and catastrophic, life-altering losses. It is a brutal, necessary education. Welcome to Capitura. Today, we're not just exploring a strategy. We're studying the mind of a true financial maverick. We are going step by step through the exhilarating and cautionary tale of one of the greatest and most famously defeated speculators of our time. Education of the Speculator by Victor Niederhoffer. The author and the intellectual arena. Victor Niederhoffer is not a typical Wall Street figure. He holds a PhD in finance, was a professor, served as a partner to George Soros, and was a national squash champion. This unique background, combining rigorous mathematical intellect, physical discipline, and real-world trading experience, is the lens through which he views the market. For Niederhoffer, the market is not just a place to make money. It is a testing ground for life's most difficult lessons. He sees parallels between trading and chess, tennis, and even biological processes. His methodology is a blend of statistical anomaly hunting, the belief that markets are not truly random, and contrarian aggression. The book is an unapologetic look at the speculator's mindset. It celebrates the intellectual pursuit of the edge, but is ultimately a cautionary tale, as Niederhoffer's own massive, highly leveraged hedge fund suffered a near-total collapse during the 1997 Asian financial crisis. The lesson is delivered by both triumph and trauma. Why the speculator's education still matters. Niederhoffer's book is more relevant than ever because the modern market has blurred the line between the disciplined speculator and the reckless gambler. The democratization of speculation, commission-free trading, and easy access to options and leverage have turned millions of retail investors into de facto, untrained speculators. The average Robin Hood trader is attempting a speculative game without Niederhoffer's discipline or statistical rigor. Meme stocks in the speculative herd. The GameStop and crypto phenomena are mass exercises in speculation, driven by sentiment and the pursuit of abnormal returns. Niederhoffer's statistical analysis provides a lens to understand the true underlying probabilities of these wildly volatile assets. The danger of hubris. Niederhoffer's own collapse is the ultimate warning against hubris and excessive leverage. The story teaches a FIRE investor that a single catastrophic, high-leverage bet can wipe out decades of disciplined saving in a matter of hours to no effect. We are going to start this challenging journey, exploring how the relentless pursuit of an intellectual edge can lead to both immense wealth and total self-destruction. Chapter 1. The Arena. Niederhoffer opens by framing the market as an arena, a competitive, zero-sum environment where one's success depends on failure of others. This contrasts sharply with the passive investor's view of the market as a slow, wealth-generating machine. The market as a test of life. For Niederhoffer, the market is the ultimate testing ground. Mental and physical discipline. He draws parallels between the rigorous training required for championship sports, like squash, and the mental discipline required for speculation. Success demands relentless preparation, deep statistical knowledge, and the ability to perform under extreme psychological pressure. Contrarian philosophy. The speculator's job is to exploit the systemic flaws created by the emotional and predictable actions of the crowd. The arena is filled with amateurs who panic and chase momentum, creating the anomalies that the professional speculator profits from. The crowd's weakness is the speculator's strength. Defining speculation. Niederhoffer distinguishes between speculation and investment. Investment, long-term focus on fundamental value, seeking returns anchored to economic growth beta. Speculation, short-term focus on price anomaly, seeking excess returns by exploiting temporary mispricing and volatility. Speculation is an active attempt to generate alpha. The speculator is engaged in a daily battle to prove the efficient market hypothesis. YMH, wrong in small, discrete ways. Modern investing application. The arena concept defines the mindset of today's speculative retail trading. Robinhood as a coliseum. The commission-free trading environment is a perfect modern arena. Millions of retail traders are engaging in a zero-sum speculative battle. Niederhoffer's work warns that without the statistical and psychological rigor, these retail traders are simply the amateur crowd being exploited by the professional speculators and algorithms. The crypto volatility game. The extreme volatility of Bitcoin and altcoins makes them the ultimate speculative arena. The wide price swings offer massive potential alpha, but the lack of fundamental anchors means the risk is pure wild randomness, no effect. Only the speculator with iron discipline can survive this arena. Passive investors' defense. The passive investor's choice of an ETF is essentially a choice to avoid the arena entirely. They opt for the long-term, low-volatility returns of the overall economy, refusing to pay the psychological and financial cost of daily speculative combat. The key lesson of Chapter 1 is that speculation is a full-time intellectual and psychological commitment. If you lack the rigor of a world-class athlete, you will be consumed by the arena. Chapter 2, Discovering a Statistical Edge. This chapter moves from philosophy to practice, detailing Niederhoffer's core methodology, the systematic search for statistical anomalies that create a predictable short-term edge. Markets are not perfectly random. Niederhoffer challenges the academic view of the market as a perfect, smooth, random walk. His work focuses on the idea that financial data is clumpy and exhibits measurable deviations from perfect randomness. Short-term anomalies. He looked for repeatable, short-term patterns that suggested market inefficiency. These include tendencies for prices to revert to mean after extreme jumps or for volatility to cluster, the Joseph effect. The opening gap. A key example is his work on the opening gap. He observed historical tendency for stocks that opened sharply higher or lower to exhibit a measurable, short-term mean reversion pattern. This provided a high-probability trade opportunity that data-driven skepticism. Niederhoffer did not rely on sentiment or guru opinions. Every trade idea was subjected to rigorous historical testing to ensure the statistical edge was real, robust, and predictable. The edge of mean reversion. Niederhoffer's approach often centers on mean reversion, the tendency of prices to return to an average after an extreme move. Emotional extremes. He posits that short-term price extremes are caused by transient emotional overreactions by the crowd. The speculator profits by betting that the crowd's emotion will subside and the price will snap back to its statistical average. This is the ultimate contrarian trade. Modern investing application. The search for statistical edges is the foundation of the modern quant world. Algorithmic trading. Niederhoffer's statistical anomaly hunting is the blueprint for today's high-frequency trading, HFD, and quantitative funds like Renaissance Technologies. These firms use massive computational power to identify and exploit the same short-term statistical mispricings, but at microsecond speeds. Retail mean reversion. The retail trader who observes that a stock like GameStop has fallen 30% in a single week and buys it, hoping for a bounce, is attempting a crude form of mean reversion. Niederhoffer's work warns that without the rigorous historical testing and understanding of the underlying probability distribution, Levy-Stable versus Gaussian, this trade is pure guesswork. The time decay edge. Niederhoffer also explored volatility anomalies. Today, the consistent profitability of selling options premium, betting that volatility is overstated, is a statistical edge exploited by hedge funds. This is a disciplined, high-probability trade against the emotional overestimation of risk by the amateur crowd. The key lesson of Chapter 2 is that real alpha is not found in genius foresight. It is found in statistical anomaly. The disciplined speculator must dedicate their life to finding, testing, and exploiting measurable deviations from randomness. Chapter 3. The use of leverage. This chapter addresses the elephant in the speculator's room. Leverage. Niederhoffer makes it clear that while leverage is necessary to amplify the small statistical edges into significant returns, it is also the ultimate source of catastrophic, life-altering risk. Leverage as the great multiplier. Niederhoffer views leverage, the use of borrowed capital to increase the potential return of an investment, as the essential tool of the speculator, amplifying the edge. Since the statistical edges are typically small, e.g., a short-term probability of 55% success, leverage is required to multiply the small, high-probability gains into meaningful returns, The asymmetry of risk. Leverage turns a manageable risk into an asymmetric existential risk. The small statistical edge is multiplied, but the probability of a ruinous, sudden market move, the no effect, is also multiplied. The psychological trap. Niederhoffer notes the psychological danger of leverage. The illusion of immunity. Successful early leverage creates an illusion of control and hubris. The speculator begins to believe they are immune to the downside, leading them to increase the size of their bets. The near-death experience. Leverage ensures that when the inevitable low probability, high-impact event occurs, the loss is total or near total. Niederhoffer's own collapse in 1997 was a direct result of excessive, concentrated leverage. Modern investing application. The lesson of leverage is the most critical for today's retail investor. Retail margin and options. The easy availability of margin accounts and short-term options trading, which are inherently leveraged products, has exposed millions of retail traders to the existential risk Niederhoffer experienced. A simple, sudden market reversal can wipe out an entire account, something that would be impossible with a non-leveraged position. The FIRE investor's anti-leverage rule. The FIRE investor must adopt a zero-leverage policy. Their goal is capital preservation, and leverage fundamentally introduces the risk of permanent catastrophic loss, ruin. Controlling the edge. The professional speculator's use of leverage is meticulously sized and hedged. The amateur's use of leverage is often emotional, chasing momentum, greed, and is not coupled with the necessary statistical rigor. The key lesson of Chapter 3 is a brutal one. Leverage is a fire that forges greatness, but it is also the fire that consumes everything. A speculative system is only as strong as its ability to survive its maximum leverage catastrophic loss. Chapter 4. Playing the game of chance. This chapter is a philosophical look at the role of chance and probability in the speculator's life, framing trading as an exercise in managed uncertainty, probability, and the gambler's fallacy. Niederhoffer acknowledges that the speculator is essentially a high-stakes gambler. Manage uncertainty. The goal is not to eliminate chance, which is impossible, but to manage it by ensuring that the probabilistic edge is always in your favor. The speculator must accept that even the best-tested statistical edge will fail almost half the time. The gambler's fallacy. He warns against the common human error of the gambler's fallacy, the belief that random events are influenced by past outcomes. E.g., if a trade has failed 5 times in a row, the next one is due to win. The speculator must adhere to the objective statistical probability, not the emotional memory of past failures. The Kelly criterion and position sizing. Niederhoffer implicitly champions the importance of position sizing, how much capital to risk on a single trade. The edge of survival. Disciplined sizing is the key to surviving the low probability losses. A trade must be sized so that the potential loss does not compromise the ability to continue trading. The ultimate loss is ruin, the inability to continue playing the game. The Kelly criterion, while not explicitly focusing on the math. The philosophy aligns with the Kelly criterion, a formula that suggests the optimal position size based on statistical edge and the probability of success. Modern investing application. The philosophy of managed chance applies directly to the speculative retail allocation. Sizing the crypto bet. A disciplined speculator treating Bitcoin as a managed gamble would use the philosophy of chance. They would allocate only a small fixed percentage of their net worth to the asset, accepting that it is a high-variance, high-reward bet on future structural change. They are managing the size of the loss if the low-probability failure occurs. The sunk cost fallacy. Niederhoffer's emphasis on probability is the antidote to the sunk cost fallacy. If a stock has dropped, the decision to hold or sell must be based on the future probability of a win, not the emotional memory of the capital already risked. The passive investors. Certainty. The passive investor manages chance by choosing the high probability bet of the overall market. They accept the short-term chance of loss, but rely on the near certainty of the long-term Joseph effect, economic growth. The key lesson of Chapter 4 is that the successful speculator is not a gambler. They are a statistician. They transform games of emotional chance into exercises in objective, managed probability. Chapter 5. Trading the Cycles of Life. This chapter draws philosophical parallels between the cyclical nature of human life, birth, growth, death, and renewal, and the cyclical nature of market prices, cycles, and persistence. Niederhoffer argues that the statistical anomalies he exploits are rooted in the cyclical, non-random nature of human behavior, the market as a living entity. The market is not an abstract statistical phenomenon. It is a collective of human emotions and actions subject to the cycles of fear and greed. This cyclical nature creates a persistence and the anomalies. Contrarian interpretation. The speculator profits by betting against the extremes of the cycle. When the crowd is euphoric, late growth/peak, they short. When the crowd is panicked, late decline/trough, they buy. They are betting that the market's current emotional state will regress to the mean. The role of history and memory. Niederhoffer's statistical analysis is deeply rooted in historical data. History does not repeat, but it rhymes. The speculator looks for historical patterns and precedents to inform their statistical model. They understand that while the actors and assets change, the fundamental emotional cycles of the crowd remain the same. This is the mathematical basis for the Joseph effect in price movements. Modern investing application. The life cycle view applies to the analysis of modern, high-growth companies. The Tesla life cycle. The price movement of Tesla has reflected a full speculative life cycle. It went from the skeptical base phase, chapter 1, to the massive, euphoric growth/peak phase. A Niederhoffer speculator would have used statistical models to identify the peak volatility and shorted the stock when the price movement became statistically unsustainable. The meme stock cycle. Meme stocks are characterized by highly compressed, short cycles. They explode in the euphoric growth phase and suffer a catastrophic panic/decline phase. The speculative opportunity lies in identifying the high probability point of mean reversion, the long-term cycle. The FIRE investor benefits from recognizing the long-term, multi-decade cycles. They recognize that recessions are the inevitable death phase of the cycle, and they use this period to accumulate assets cheaply, knowing that the renewal next bull market is statistically guaranteed. The key lesson of Chapter 5 is that the market's movements are not purely mathematical. They are psychological. The disciplined speculator must read both the statistics and the collective emotional state of the crowd. Chapter 6. The Wisdom of the Crowd. This chapter offers a highly nuanced view of the crowd. While the speculator profits from the crowd's irrationality, Niederhoffer acknowledges the occasional wisdom and undeniable power of the collective. When the crowd is wrong, the crowd is most predictable and most wrong at the extremes of emotion. Emotional overreaction. The crowd overreacts to short-term news, causing extreme deviations from the mean that the speculator exploits. Persistence of error. The crowd's Joseph effect persistence allows trends and errors like bubbles to last far longer than rational analysis suggests they should. When the crowd is right, Niederhoffer respects the power of the collective. The median is strong. While the extremes are flawed, the market's underlying consensus, the median price, is often a strong reflection of collective information and belief. The speculator's bet is never that the market is wrong forever, but that it is wrong only temporarily. The fear of the squeeze. The greatest fear for any short seller is a coordinated action of the crowd. The GameStop short squeeze is the ultimate example of the crowd's power to enforce its will, even against objective statistical analysis. The speculator must always respect the collective psychological momentum. Modern investing application. The balance between crowd wisdom and crowd folly is key to today's market participation. Index funds and crowd wisdom. The passive investor's choice of an index fund is the ultimate bet on the wisdom of the crowd. The index is a collective, low-cost consensus of millions of participants. By betting on the index, the investor captures the statistical base rate of the market. The social media herd, folly the meme stock crowd, is a case of folly amplified by technology. The price movement is driven by concentrated, non-fundamental momentum Joseph effect, which a disciplined speculator would identify as a high-probability mean reversion opportunity. The contrarian sizing. Niederhoffer's lesson for the disciplined speculator is to size their contrarian trades conservatively. The position size must reflect the power of the crowd to resist a statistical snapback for a prolonged period. The key lesson of Chapter 6 is that the crowd is rarely wrong, except at the extremes. The intelligent speculator must know the statistical difference between a temporary mispricing and an enduring trend. Chapter 7. The Perils of Forecasting. This chapter takes on futility of long-term forecasting and why the speculator limits their focus to short-term statistical probabilities. Long-term versus short-term uncertainty. Niederhoffer asserts that the market is a system where uncertainty compounds rapidly over time. Chaos theory. The market is highly susceptible to small, initial changes, the butterfly effect, that become massive, unpredictable outcomes over the long term. This makes long-term predictions, e.g., where the S&P 500 will be in 10 years, an exercise in guessing short-term predictability. However, the speculator can find temporary, measurable predictability in the very short term. These are the statistical anomalies that have not yet been arbitraged away by the market. The goal is to profit from these small, near-term imbalances, the risk of being right too early. Niederhoffer's own experience highlights the danger of being correct about a long-term fundamental trend, but being early on the timing risk. The speculator's challenge is not just identifying the edge, but successfully timing the exploitation of the edge. If a trade is executed too early, the speculator may run out of capital due to leverage costs or drawdowns before the predicted snapback occurs. Modern investing application. The futility of long-term forecasting is the intellectual basis for the passive approach. The passive investor's humility. The FIRE investor accepts the impossibility of long-term market forecasting. Their strategy, buying and holding, is a humble admission that they cannot predict the market, but they can rely on the statistical certainty of the long-term Joseph effect, economic growth. The Tesla valuation forecast. Long-term fundamental analysts who try to forecast a valuation of Tesla often failed. The high volatility and susceptibility to hype meant that the true long-term value was obscured by the short-term emotional swings. Niederhoffer's approach would limit the trade to exploiting short-term mean reversion rather than attempting a decade-long prediction. Crypto forecasting. Long-term forecasts for Bitcoin, e.g., $1 million by 2030, are often based on simple extrapolations, ignoring the compounding uncertainty and the high probability of systemic shocks. The educated speculator limits their trade to short-term volatility arbitrage. The key lesson of Chapter 7 is that the more distant the forecast, the closer it is to speculation. Disciplined speculation must be anchored to near-term, testable probabilities. Chapter 8, The Price of Discipline. This chapter returns to the theme of discipline, detailing the emotional and financial costs required to maintain a successful speculative system. Discipline as emotional detachment. Pring's concept of discipline is deepened by Niederhoffer's experience. Mechanical execution. Success requires the mechanical execution of the statistically derived system without emotional input. The trade must be executed even if the speculator's intuition is screaming against it. Emotional cost. The cost of this discipline is high. It means accepting the short-term loss aversion, instantly and without hesitation when the stop-loss is triggered. It means enduring the psychological pain of being wrong frequently. The importance of routine. Niederhoffer emphasizes the role of physical and mental routine. Maintaining peak mental performance through exercise and rigorous daily habits is necessary to prevent emotional fatigue from compromising trading discipline. The cost of failure. Niederhoffer's own collapse underscores the price of failure. The failure of discipline, or the failure of the model to account for the extreme event, results in the instant erasure of capital. The cost of that failure is both financial and psychological. Modern investing application. Routine and detachment are the only defenses against the hyperactive modern market. The unplugged investor. For the passive investor, the ultimate act of discipline is to unplug from the daily news and emotional noise of the market. They execute their automated buy, and they ignore the price fluctuations. This detachment protects their long-term plan from the cyclical emotional madness, stop-loss execution. The speculator must have the discipline to execute a hard, automatic stop-loss. The moment a trade moves against a statistical probability, the loss must be controlled before the no effect turns it into ruin. The FIRE discipline. The FIRE movement requires immense long-term discipline. It is a sustained, multi-decade adherence to a financial plan, resisting both the greed of speculative fads and the fear of market downturns. The key lesson of Chapter 8 is that discipline is the bridge between a sound statistical system and a successful outcome. Without it, the greatest statistical edge is just an expensive gamble. Modern context expansion. If Victor Niederhoffer were to observe today's markets, He would see a world where the statistical anomalies he sought are both hyper-amplified and instantaneously destroyed. Vindicated by statistical anomalies. The quantification of anomalies, the massive success of quantitative funds, like Simons' medallion, is the ultimate vindication of Niederhoffer's core thesis. Markets are not perfectly random, and short-term statistical edges exist. The difference is scale and speed. The anomalies are now exploited by algorithms at the microsecond level. Speculation in the digital age, the Robinhood and meme stock phenomena, will be viewed as a goldmine of psychological anomalies. The massive emotional overreactions and price spikes create short-term mean reversion opportunities that are ripe for exploitation by a disciplined, statistically minded speculator. The danger of the amateur speculator. Niederhoffer would be deeply concerned by the amateur speculator. Leverage without rigor. The easy access to options and margin has given the amateur the tool of leverage without the necessary statistical rigor and position sizing discipline. This is a recipe for a high-frequency ruin. The illusion of alpha. The retail speculator believes they are finding alpha, but they are often simply engaging in high-cost gambling, unaware that the statistical edges are being constantly harvested by the professional quants. Sizing for survival. The lesson in his own collapse is that survival is the only true edge. Position sizing must be calibrated to ensure that even the statistically impossible loss, no effect, does not lead to ruin. The antidote to FOMO. The speculator's discipline in only entering a trade when a statistical edge is present is the ultimate antidote to FOMO. If the trade is based on hype or momentum, the probability is against the speculator. The modern market is a perfect laboratory for Niederhoffer's ideas. The speed of the market increases the opportunity for statistical anomalies, but also increases the speed and finality of ruin for the undisciplined. Closing reflection. We have explored the intellectual and psychological crucible of Victor Niederhoffer's education of a speculator. It is a powerful reminder that the market is the ultimate mirror, reflecting the depths of our discipline, our hubris, and our capacity for recovery. Here are 10 timeless lessons from the speculator's journey for the intelligent investor. Define your game. Be honest about whether you are pursuing beta, passive, low risk, or alpha, speculative, high risk. Do not mix the strategies. Ruin is the ultimate risk. Never engage in any speculative activity that risks ruin, the complete loss of the ability to continue playing the game. Leverage is for experts. Only use leverage when coupled with statistically rigorous, highly disciplined risk management system. For the amateur, zero leverage is the safest course. Find a statistical edge. Speculation is not guessing. It is a scientific pursuit of statistical anomalies, deviations from randomness. Focus on mean reversion. The market is cyclical and emotional extremes lead to temporary mispricing. The profitable trade is often a contrarian bet on the snapback to mean. Position sizing is survival. Calibrate the size of every trade to ensure that the maximum possible loss does not compromise your financial survival. Embrace frequent loss. A high-probability speculative system will still fail almost half the time. Discipline means accepting these small losses instantly and unemotionally. Discipline is mechanical. The system must be executed mechanically, regardless of the speculator's intuition or emotional state. The crowd is an anomaly. The crowd is most wrong and most exploitable at the extremes of the emotional cycle. Use the crowd's emotional signal as your entry and exit points. Routine is capital. Maintain peak mental and physical discipline through rigorous routine. The speculative game is won or lost in the mind. How to apply these lessons right now. Adopt the two-account system. Maintain your core, non-leveraged FIRE portfolio in passive ETFs. If you choose to speculate, use a small, separate speculative account, the arena, with capital you are prepared to lose entirely. Institute a hard loss limit. For your speculative account, institute a maximum loss limit, e.g. 5% to 10% drawdown, that automatically triggers a halt to all trading until the market moves past the emotional extreme. Prioritize recovery. Recognize that the biggest lesson is recovery. The ultimate discipline is the ability to return to the system, humbled but intact, after a catastrophic failure. The speculator's education is a lifelong commitment to intellectual honesty and relentless self-control. By studying their path, we learn that the greatest victories are found not in the market, but within the disciplined self. And there you have it, the fierce, uncompromising wisdom of Victor Niederhoffer's education of a speculator. It's a powerful testament to the risks and rewards of intellectual audacity in the financial arena. We hope this deep dive summary has given you the clarity to define your own game and the discipline to manage your risks with the rigor of a champion. If you found value in this breakdown of education of a speculator, make sure to subscribe to Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom, chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be a disciplined warrior in the financial arena